let's get to our talking point conversation this morning. Pramod Gubbi, Marcellus Investment Managers in studio with us. Pramod, great to have you, and always great to have a conversation in studio. So thank you for dropping by.
No, thanks for having me. It's always a pleasure.
All right, let's start talking about your view about what's happening right now in the markets, and then of course we'll get to what segments you like or what your mood is. Are you feeling optimistic right now, cautiously optimistic, or in that zone where you're saying let's sit on the sidelines?
Well, I think the answer is in the nuance, like always, right? I think the long-term macro is fairly intact. I don't think there's any doubt. Of course, there is cyclical slowdown in certain sectors, but that's part of the deal, right? I mean, economies, businesses, markets always go in cycles. Nothing moves linearly. To that extent, I think that given we are long-term investors, we're quite positive on the macroeconomic fundamentals. Yes, we would like the markets to be a little cheaper than where they are, particularly the sort of stocks that we like in quality. We did see some hope with the sort of correction we've seen in the last couple of months. I hope that correction sustains and gives us opportunities to buy into great businesses from a long-term perspective at reasonable valuations.
No, so you don't think valuations have come off enough? Because you're saying you hope the correction sustains. Trend lines are pointing to perhaps a recovery from here on.
So I don't know. I mean, it's futile to predict markets in the short run. I've tried to do this for the last 20 years. Honestly, I can't do it. I haven't met anybody else who could do it. But to the extent that we have the luxury of taking long-term calls, I would rather wait for more reasonable valuations, more from a fundamental perspective. I'm not talking about whether tomorrow you'll get a better price or not. But looking at earnings and long-term earnings growth potential, I do think that you'll need a little more margin of safety before you can say that I can start buying now.
And if for whatever it is worth, we have borrowed returns from the future. We've had a phenomenal run despite the fact that we've corrected. And even if you look at those FI numbers, they're not even taken off a little bit profit off the table, right, with the kind of wealth that they've created and generated by allocating to India in the last 1 year. But Pramod, let's get down to actionables. We had a very rough October. We had a very rough November as well so far. What were your clients doing? Have they doubled down on their allocations in India? Have you picked up the phone and said, you know what, if you've got money on the sidelines, bring it on? Or are you still waiting?
We're still waiting. In fact, a lot of the global institutional allocators have clearly done their homework on India, and clearly
They're telling you to wait.
Not really. They're asking us. You tell us when should we, press the button. We're saying wait.
Why is that?
Like I said, at the end of the day, I mean, you're saying markets are down 8–9%. Isn't that enough of a correction? But look at it this way, even earnings are down 8–9%. So multiples haven't changed materially enough. There are two outcomes. If you think that the earnings are going to be strong enough, hopefully you will outgrow those multiples and multiples will become attractive. But right now what we're seeing is the other way around, where earnings weakness has meant that despite the correction, markets haven't become any cheaper. But like I said, leave aside the shorter term, even from a longer term perspective, some of the quality businesses, we would like to see more sensible valuations before we can bang the table and tell our clients, this is the time to buy India. And I think they are on side with that. We've got long history of starting valuations having an impact. Like you said, you borrowed returns from the future. The fact that we've had a great run over the last 3–4 years means that from this point on, we should be prepared for relatively lower returns. Of course, there'll be pockets of the market which will do better, which has been the case over the last decade as well. Say 2020 to 2020, between say 2G and COVID, you had a fairly muted market experience, yet there were sectors and stocks which did remarkably well. But that's our job as asset managers to identify those.
No, you're right. And you talk about earnings. I mean, India is shown single-digit earnings this quarter. Second half hopefully looks better, but the US has got double-digit growth. So the mother market will continue to be the hotspot for investors. But you talked about how this is a stock pickers market, bottom-up approach is what most asset allocators would be doing. But in your opinion, which sectors have been affected most in the recent correction? Are there any pockets of value or interest that you're seeing?
I think private sector financials remain perhaps the only pocket of value.
ICICI,
yeah, banks and a few NBFCs which are quality, which have corrected over the last couple of months.
What about capital market players?
Capital markets players are cyclical. Yeah, no, absolutely. Look, structurally, we're very positive because I think we built Marcellus to capitalize on the structural trend of financialization of savings by Indian households. Historically, Indian households have been very heavy on real estate and gold. It's only over the last decade or so there is conviction building in financial markets, and therefore you're seeing the flood of money coming into mutual funds, PMSs, AIFs, and several other financial assets. And that trend, I reckon, is multi-decadal. Having said that, this is not going to be a linear story. Capital markets are cyclical by definition. I don't know where we stand in the cycle, but given the trend over the last 3 years, you'd reckon earnings are on the higher side. They're certainly not trough earnings. On top of that, the market is giving multiples to these capital market plays at a premium. So you're buying into them at premium multiples at what could potentially be peak earnings as well, from a cyclical perspective. If you were to take a longer term view, of course, you will still make a lot of money from capital market plays. But like I said, we're all greedy. We would want these great companies available at cheaper valuations.
In the long term, we're all dead also. But just last point, Pramod, there you talked about capital market play, but if you were to identify one or two sectors that you think are ripe enough or close enough to valuations where you feel fresh money can come in, what would those be?
Yeah, hands down, it has to be private sector banks, right? So where we've seen an element of quality still intact in terms of asset quality. When you're investing in a lending business, that's perhaps the foremost thing. And they are cheaper than historical valuations.
Just a quick 10-second answer. What are you feeling about export-oriented sectors? So pharma and IT, because the Trump party and the China tariffs could work well for us.
Yeah, I mean, IT and pharma are perhaps one of the few sectors where you have some earnings visibility. Earnings visibility is important, particularly when valuations are high. By no measure, pharma and IT are cheap on an absolute basis. But relative to the rest of the market, given the earnings certainty and predictability, I reckon those would follow private sector financials in terms of our pecking order of sectors.
Okay, so financials, IT, pharma, and in financials, private sector banks on top of the heap. Always a pleasure to speak with you, Pramod.
My pleasure.
Thank you so much, Pramod Gubbi of Marcellus here on his top ideas on Talking Point.